Hey, welcome back to the Consulting Mind. Today, I'm going to share with you top 5 highlights from Bridgewater Co-CIO Prince on the global market outlook. The first highlight will be there are 3 key major elements that we have to watch and monitor closely, which are the collapse in global income, the spread of COVID-19 virus, and the zero interest rate. The COVID-19 has brought a disastrous impact to the economy in the sense that it reduced both the capability and the willingness for the people to spend as their income are significantly affected. Many of them has become unemployed, as you can see the soaring unemployment rate and the rising initial jobless claim. And even those who are able to survive and remain employed, the business industry outlook has remained doomed and uncertain. So people are less willing to spend and less willing to invest in this kind of situation. And the zero interest rate is one of the solution by the Fed or by the other central government, central bank, in order to inject liquidity to the market with an aim to offset partial of the negative economic impact brought by the virus. The second highlight will be the MP3 is going to be the solution. As a very quick recap, in Monetary Policy 1, the MP1, the central bank will focus on the traditional monetary policy where they will focus on the interest rate cut or interest rate hike in order to influence the short-term rate and influence the cost of the credit. And in MP2, the central bank will focus in using the quantitative easing, the bond purchasing program, to influence the bond yield via either buying the government bond or other related bond. And in MP3, there is actually a combination of fiscal and monetary policy, where it is a more directed program as spender rather than the investor, which are the groups that MP1 and MP2 principally target. Under MP3, the central bank will remaining printing money, but the money will be provided to spender with the incentive to spend more to stimulate the economy via some fiscal policy. The third one will be there is a duration mismatch, and this would be problematic. What does duration mismatch mean? On one hand, we have the soaring unemployment rate, the climbing initial jobless claim, which means that the income has been slashed and has been cut dramatically. Despite there are some stimulus payment from the government offered in the previous month, but that could only be lasting for 3 to 4 months, likely till summer. But on the other hand, we have the virus, which is likely to be last for 18 to 24 months or even longer, depending on the vaccine status. So fundamentally, there is a mismatch. So fundamentally, we'll say there is a mismatch when the subsidized or when the stimulus payments can be only last for about a quarter, but the impact of the virus can actually last for 18 months or even more. As therefore, there is a gap between the virus on impact on the income versus how long people can last financially riding on the stimulus. This is what the duration mismatch means. The fourth one will be the unemployment rate. As you can see from the chart showing the US 25-year unemployment rate trend, you can see after the COVID-19 or during the COVID-19, the unemployment rate has been skyrocketed to as high as close to 15%, although it has been reduced to about 11% now. It was still a very, very high number though. It has a very strong indication of the shortage of income. As a comparison, you can see during the 2008 financial crisis, the peak was only about 10%. And then you may wonder, 10% versus 11%, it is not that worse. But you have to remember that back then, our interest rate has not yet been cut to zero, and the balance sheet, the Federal Reserve balance sheet, has not yet been reaching $7 trillion by then. Not to mention the growing physical deficit. And finally, there are three must-known bases for portfolio structuring, which are reflation, the storehold of value, and the differentiation. First of all, let's talk about reflation. Normally, we'll think of cash as the risk-free asset, which is true in most circumstances. But in the era or in the likelihood of the reflation period, holding cash will actually bring us the negative real rate of return, and therefore we should look for something that should be able to store hold of value instead, which include gold or other inflation-linked bond. With gold being a very common vehicle for hedging the inflation risk, and for those inflation-linked bond, their price and their value will rise according to the rising inflation rates. And the final one will be the importance of the differentiation. So this is the end of the top 5 highlight, and I hope it would help you. If you like the video, please click the like and subscribe button, and see you later.